Silver investors, look at the chart and you'll hear the same line everywhere. Relax, silver just pulled back a little. Holiday week, nothing to see. But when you look under that calm surface, you see the 6th consecutive annual deficit, 800 million ounces of missing metal, and a $4.3 billion streaming deal where giants are quietly locking up future silver while retail panics about a 3% dip. I'm OG John AG, and in this video I'm going to show you why this holiday volatility narrative is a cover story, why the real plot is a structural squeeze plus big money front-running the future, and how the 73-72 support zone you're staring at on your screen fits into a much bigger war over who controls the next decade of silver. Segment 1. The holiday volatility excuse, what actually happened to price. Let's start with the simple picture. FX Leaders reports that over the last few sessions, silver, XAG/USD, has pulled back about 3.7% from its mid-February highs. Price is now trading in the mid-70s with key support and focus around $74.11 and a deeper floor near $72.86. They describe silver as battling holiday volatility with liquidity thinned by the Lunar New Year in Asia, the US President's Day stretch in America. Add to that a slightly firmer US dollar. FX Leaders notes, DXY up only about 0.03% in this period. Some speculative profit-taking after silver flirted with higher levels. So on the surface, the story is thin holiday markets, dollar a touch stronger, silver pulls back a bit, nothing major. And that's exactly how they want you to think, because if you stop reading there, you'll miss everything that matters. Segment 2, 6 consecutive deficits. The pressure cooker under the chart, scroll deeper into the same FX Leaders article, and the tone changes. They cite industry estimates showing that the global silver market is heading into its 6th consecutive annual deficit in 2026. The expected deficit this year is around 67 million ounces. On top of that, they note that since 2021, cumulative deficits have built up to over 800 million ounces, more than an entire year of global mine production. That means for 6 straight years, the world has used more silver than it has produced. The difference did not come from new mines. It came from draining above-ground stocks. Inventory on exchanges, in warehouses, and in private hands has been used as a buffer to pretend there is no problem. But buffers are finite. So while the surface narrative says just a 3.7% holiday dip, the underlying math says, we're running a balance sheet that's been negative for 6 years and counting, and we've already consumed 800 million ounces of extra silver to keep the lights on. That's not noise. That's a pressure cooker. Segment 3, $4.3 billion, how BHP and Wheaton just voted on the future price of silver. Now let's talk about the vote that actually matters, where serious capital is going. FX Leaders highlights a headline most retail never saw. BHP and Wheaton Precious Metals have signed one of the largest silver streaming deals ever, worth $4.3 billion. The deal? Wheaton pays billions up front to secure the right to buy silver production from the Antamina mine in Peru at a discounted price for years to come. Ask yourself, do you spend $4.3 billion locking up future silver production if you think this metal is about to be oversupplied and irrelevant? Or do you do that because you see structural deficits ahead and you want guaranteed feedstock for the next decade? Streams are not day trades. They are multi-year, often multi-decade deals. This streaming agreement is a giant vote from BHP and Wheaton that silver supply is tight enough and demand strong enough that it is worth paying billions today to control tomorrow's ounces. Now look at the contrast. Retail investors panic over a 3 to 4% pullback during a holiday week. Corporate giants lock in a multi-billion-dollar silver stream like they are front-running an entire era. Who do you think understands the real outlook better? Segment 4, Industrial Tug-of-War, Thrifting Fears versus AI and Power Demand. One of the arguments bears use is, if silver gets too expensive, industry will just use less. They'll thrift it out. FX Leaders addresses this directly. They note that analysts expect that. At sustained high prices, some manufacturers, especially in solar, may try to reduce the amount of silver per unit. This is called thrifting, engineering products to use less metal. But they also point out that any thrifting impact is likely to be offset, or even overwhelmed, by rising demand from emerging technologies. Specifically, they call out AI data centers and high-performance computing infrastructure. Power-dense electronics and advanced energy solutions that rely on silver's conductivity and reliability. So you have two forces. On one side, some per-unit savings in solar and electronics at the margin. On the other side, a massive expansion in the number of units, the scale of infrastructure, and the intensity of power usage. Net result? The industrial demand story remains bullish, even if some thrifting happens. That's why the same article can talk about deficit after deficit and a 4.3B streaming deal while also acknowledging thrifting. Big players know demand is not going away. They know tech is moving toward more electricity, more data, more infrastructure, and silver is woven into that fabric. Segment 5. Technicals, the $74.11, $72.86, and $64 levels everyone is watching. Now let's come back to the chart because FX Leaders gives very specific levels, and this is where the fear versus opportunity battle plays out. They highlight. On the 2-hour chart, silver is trading below both. The 50-period EMA around 80 to 84, the 200-period EMA around 84.30. That tells you the short-term trend is down. Key levels they mark, immediate resistance around 79.42, 79.50, a pivot area where recent rebounds have failed. Immediate support around 74 hours or 11, current downside line in the sand. Major support zone 72.86, the must-hold level in their words. Below that, a deeper structural support near $64.06. They also note, RSI on the intraday chart is oversold but still pointing down. The gold-silver ratio is near 64.1, showing silver underperforming gold in the recent pullback. So technically, there are 3 zones in play. Above 79 or 80, silver starts to heal the damage. Between 74 to 73, fear grows, but the long-term bull is intact. Below 72.86 towards 64, panic for weak hands, potential gift zone for strong hands. The chart is setting the emotional trap. The fundamentals will decide who falls into it. Segment 6, the holiday environment. Thin liquidity is a weapon, not an accident. FX Leaders spends time on the holiday context, and that's important. They point out that the Lunar New Year in Asia and US holidays create a patch of thin liquidity. In those windows, modest flows can cause outsized price moves. This is where the OG lens kicks in. Thin liquidity is not just a condition, it is a weapon. Big players know order books are shallow. They know Asian physical demand is temporarily offline or reduced. They know technical traders will overreact to sharp moves in quiet sessions. So if you want, cheaper entries. Stop runs below obvious supports. Time to accumulate without too much competition from the east. Holiday weeks are perfect. FX Leaders frames it diplomatically, battling holiday volatility. What that really means is, this is the kind of week where the price can be pushed around easier than usual, even though nothing in the long-term supply-demand picture has improved. If you confuse thin tape theatrics with fundamental change, you'll hand your medal to someone who understands the difference. Segment 7, GSR at 64, reading what gold versus silver is telling you. FX Leaders notes that the gold.silver ratio, GSR, is sitting around 64.1. What does that mean in plain language? It takes 64 ounces of silver to buy 1 ounce of gold at current prices. Historically, extremes in this ratio often mark major turning points. In deep crises, the ratio can spike over 80 or even 90 in favor of gold. In silver mania phases, it can compress down into the 40s or even lower. At 64.1, we are not at a blow-off silver peak. We are in a zone where gold has been doing its job as conservative money. Silver has been more volatile and is now underperforming in the latest pullback. For a long-term stacker, that often means you are being offered silver at a discount relative to gold, even as structural deficits and corporate deals scream that silver's role in the system is rising, not falling. You don't have to time this to the day. You just have to ask, do I think this ratio will be higher or lower when the current debt inflation cycle finally cracks? If you believe silver will catch up or outperform in the later stages of stress, then 64.1 in a deficit world is not a bearish signal. It's a positioning signal. Segment 8, the psychology trap at $73. Fear for some, opportunity for others. Let's focus on the 74 to 73 zone, because that's where FX Leaders says support is nearing. Psychologically, here's what happens. Retail investors who bought higher see red on the screen and think, I knew it, this was all a bubble. If $72.86 breaks, it's over, I have to get out. Short-term traders see price under the 50 and 200 EMAs and think, trend is down, rallies are to be sold. Meanwhile, in the boardroom, you've got BHP and Wheaton wiring 4.3B into a silver stream, analysts talking about a 6th straight deficit and 800 mayas of cumulative shortfall, corporates and miners modeling multi-year AI and infrastructure demand. The market is setting up a gap between price anxiety on the chart, long horizon conviction in the real economy. If you think like a trader with a 3-day horizon, $73 looks like danger. If you think like a corporation with a 10-year horizon, $73 looks like a rounding error. The question is, which side do you want to stand with when the deficits finally reprice? Segment 9, how to position trader versus stacker in this environment. So practically, what do you do with this FX Leaders outlook? If you are a short-term trader, respect the technicals. Under the 50 and 200 EMAs, the path of least resistance is down until proven otherwise. 79.42, 79.50 is your first upside test. Above that, momentum can shift. Know the range. $74.11 and $72.86 are your key supports. A clean break and close below $72.86 opens risk toward that deeper $64.06 zone. Understand the calendar. Holiday-thinned markets can amplify fake moves. Don't oversize positions during known low liquidity windows. If you are a long-term stacker, anchor on fundamentals, 6 consecutive deficits, 800 ME Aussie cumulative shortfall, 4.3B streaming deals and industrial growth, use fear zones as buy zones, not panic zones, but with discipline, scale in across levels instead of going all in at one price. Accept that holiday raids and liquidity games are part of the journey. Don't confuse engineered volatility with a broken thesis. If deficits were shrinking, inventories swelling, and corporations exiting silver, that would be a broken thesis. What we actually have is the opposite. Segment 10, final word, calm chart, loud fundamentals. FX leaders titled this piece, Silver Market Outlook, XAG USD battles holiday volatility as $73 support nears. The mainstream way to read that is short-term turbulence but nothing too special. The OG way to read the same data is 6th deficit, 800 NE Oz gap, 4.3B streaming deal, industrial demand rising, holiday tape used to disguise stress as noise. A flat or drifting price in that kind of fundamental backdrop is not a sign that silver is irrelevant. It's a sign that the market is still letting you in before the structural math forces a new equilibrium. You've been watching John AG here, and I'm OG John AG. If this helped you see why a quiet holiday dip down towards $73 is not the story, but the setup, hit like so this kind of breakdown doesn't get buried, smash subscribe with all notifications on, and drop a comment. Holiday noise or structural squeeze? Tell me which one you see after looking at the deficits in the 4.3B streaming deal, because on this channel, we don't just chase candles. We track who is locking up ounces while everyone else blames holidays.